Hi, I'm Steve from Clearly Training, and you're watching our series of 6 short videos on finance for non-finance people. So this is a series of videos aimed at people who want to understand what accounts are all about, accounts or financial statements. So if you want to understand what a profit and loss account is, or a balance sheet, or a cash flow statement, if you want to understand words like fixed assets, depreciation, accruals, debtors, receivables, all of this language that accountants use. You know, it's sometimes when you hear accountants, it's like listening to people talking a foreign language. If you want to get into that and really understand what they're talking about, then this series of videos is for you. By the time you finish watching these videos, you'll have a good basic grounding in all of the language and terminology that accountants use. And if somebody gives you a set of accounts, you'll know what you're looking at. You'll know what the information is telling you in basic outline terms. You won't be able to prepare the information yourself, but you'll be able to look at it, understand it, and even comment on it competently by the time you've finished this series of 6 short videos. The first of these videos is going to follow in a few moments, but first of all, I want to tell you what each of the videos contains. So let's have a look at the content. So first of all, we've got a video which is going to follow in a few moments called What a Set of Accounts Tells Us. So it'll look at the elements of a set of accounts. Okay, what a profit and loss account is, balance sheet and cash flow. We'll be looking at that shortly. The second video is about something called accruals. Now, the accruals concept is fundamental to accountants. And if you understand the accruals concept, you understand the way that accountants think about transactions. And the accruals concept is absolutely vital to putting together the profit and loss account and the balance sheet. So it's really, really vital, that concept. And so to help you understand it and get a good grounding in the concept, I've used a simple example about a very, very simple business. And I'm going to talk you through that business and its basic transactions and show you how the accountant would deal with those transactions in the profit and loss account. Okay, so that's number 2. And then numbers 3, 4, and 5 all drill down into detail about the 3 financial statements. So number 3 is all about the balance sheet. So we go into a little bit of detail about the balance sheet, look at how a balance sheet is structured, look at the terminology associated with balance sheets like fixed assets, debtors, receivables, payables, and so on. Then the next one, number 4, is all about the profit and loss account. And we look at the structure of the profit and loss account and look at the terminology associated with the profit and loss account, things like gross profit, operating profit, EBIT, all these words and phrases. And then the 5th one is all about the cash flow statement. And again, we look at the language associated with cash flows. And we also look at something called liquidity, which we'll be talking about in a few moments, liquidity. And then the last one is a scoop up one where I cover other bits of accounting terminology that I think you might find useful. So we look at management accounts, budgets, and something strange called EBITDA. So you have to wait till the end to find out what that's all about. Okay, let's make a start on the first topic there. What does a set of accounts tell us? So what does a set of accounts or financial statements tell us? Why have I used 2 phrases, 2 words for the same thing? Why am I using accounts and financial statements to mean the same thing? Well, unfortunately, in the world of accounting, like in a lot of foreign languages, there are often more than one word to mean the same thing. So if I say accounts, I mean the same thing as when I say financial statements. When I started as an accountant many years ago, we just use the term accounts. And then this more modern term financial statements has crept in, a more posh term, I like to think of it as, but it still means the same thing. We're still talking about the 3 financial statements that we're going to look at if we say accounts or if we say financial statements. So let's have a look at why we need financial information and what we do with it, what we need it for. Well, we need financial information to tell us 3 things about an organization. When I say an organization, it doesn't have to be a commercial business that we're looking at. We produce accounts for charities. We produce accounts for public sector organizations as well. So although a lot of the examples in this series is about commercial organizations, the same basic documents are also produced by public sector organizations and not-for-profit organizations as well. Okay, so the 3 pieces of information we need. First of all, we need information about performance. How has an organization performed over a period of time? Okay, so 2 things there. First of all, period of time. When we're looking at a set of financial statements or accounts, we're looking at specific periods of time. Now, for example, if you're a limited company in the UK, the law requires you to produce a set of accounts at the end of each of your accounting years. So your accounting year might start on the 1st of January and finish on the 31st of December, for example. Or it might start on the 1st of April and finish in the following 31st of March, for example. You, as a business, choose what accounting period you want. You choose when it starts and when it ends, as long as it's a full year. Okay. When we prepare a set of accounts, we prepare a set of accounts for a period. And the first thing we want to know is how the first thing we want to know is how is the organization performed in that period. Okay. And when we're talking about performance, we're talking about two things. First of all, what income have we earned in that period? And secondly, what expenses have we had in that period? So performance is looking at income and expenses, or income and expenditure. Secondly, we want to know about the position of the organization. Now, the position of the organization, slightly different idea. We'll want to know the position of the organization at one particular point in time. So usually at the end of the period, we want to know what the position is. And we might also want to know what the position was at the beginning of the period as well. But definitely we want to know, where were we? What position were we in at the end of the period? When we talk about position, we're talking about position in financial terms, meaning our assets, what assets did we own, and our liabilities, what liabilities did we owe. So we want to know what our assets and liabilities are at the end of the period. And possibly we might want to know that at the beginning of the period as well. Okay, that's the second thing, position. And the third thing we want to know about is something called liquidity. Now, what do we mean by liquidity? Well, liquidity is all about your cash. So, for example, an organization that's got lots of cash in the bank is a liquid organization. It's very flexible. Yeah, it's very fluid. If you're cash rich, then you can make decisions quickly. You can make decisions about investing very, very, very quickly. Now, you don't always have to have cash in the bank to be liquid. You might have lots of access to cash. So you might have lots of customers that are just about to pay you. You haven't actually got their cash yet, but it's coming very quickly. That can make you liquid. Or you might have a bank that's allowed you a large overdraft. So that can make you very liquid because you've got access to cash. So by liquidity, we mean look at the cash inflows and cash outflows of the organization. Okay. Right, let's look at the actual names of the financial statements. You may have already guessed them, but let's have a look at the official names. The profit and loss account, or P&L, is the statement that tells you about the performance of the organization. How has the organization performed? What is its income? And what is its expense during the period? The income less the expense gives you the profit, or, of course, if your expense is greater than your income, it will create a loss. So the profit and loss account looks at income and expenses, and those income and expenses combined may end up resulting in a profit. Hopefully they do, or they may end up resulting in a loss for the period. The profit and loss account is in the nature of like a video. It shows you what's happened over the whole period, over the period from the beginning right the way through to the end. So it'll show you the income and expenses all the way through the period. So it's in the nature of like a video of the period. Okay. Now, it's also got lots of other names. The profit and loss account often abbreviated to the P&L, for example. Also, if an organization decides it wants to produce its own profit and loss account, maybe on a more regular basis than it's legally required to do, often organizations produce profit and loss accounts at the end of each month to track their performance. And they often refer to that internally produced profit and loss account as their management accounts, the accounts that are produced for the managers of the business to track their performance. So sometimes the P&L is known as the management accounts. There is also another official term for the profit and loss account, another legal term. It's not very often used, but you might hear it, and that is the income statement. Yeah, the income statement doesn't quite sound like it's the profit and loss account because it only refers to income, but it is the official name for the profit and loss account. Sometimes you'll see it in legal documents. You'll see the profit and loss account referred to as the income statement, but it's not very commonly use. So there's other names for the P&L, but most people refer to it as the P&L or profit and loss account. Now, the statement of position, that's known as the balance sheet. So the balance sheet is the statement of position that shows you where you are, what your assets and liabilities are at a particular point in time. And that too has got other names, not as many as the P&L, but its other official name is the statement of financial position, which is actually quite a good name for it. Again, it's not very often heard, it's not very often seen, but it is another legal term for the balance sheet. So you may hear it. What's very different in nature with the balance sheet is that the balance sheet isn't like a video. It's more like a photograph as an analogy. It's sometimes known as a snapshot in time. It shows you what the assets and liabilities were at one point in time. So it will show you what the assets and liabilities were at the end of the period that you're looking at. And it might also show you what the assets and liabilities were at the beginning of the period that you're looking at. And you know what? There's a big connection between the profit and loss account and the balance sheet, because if you start off in a particular position at the beginning of the period in the balance sheet, and then you have a really fantastic performance and you make loads and loads of profit over the period, then by the end of the period, your position will be better. That just makes sense, doesn't it? And the opposite's also true. If you start off in a particular position and you have a really terrible year and you lose loads of money, you make massive losses, then you're going to have a much worse position at the end of the year. So the photographs that you take, the balance sheets showing your position at those particular points in time, will be affected by your performance during that same period. So that's the profit and loss account, balance sheet, very much interconnected. And the third thing we look at is that liquidity statement, and we call that the cash flow statement. Now, the cash is just one of the assets that sits on our balance sheet, but we're very, very concerned as a business about this particular asset because it's vital to us. We can't survive without cash. Why not? Well, organizations need to pay their staff, and their staff want paying in cash. Yeah, when you go, wages go in, you don't want a promissory note, you want cash in your bank. Suppliers want paying in cash. And you know what? If you're going to expand and grow, it's much easier, rather than going to a bank and asking for a loan, it's much easier if you've already got the cash in the bank to invest in new assets. So cash flow is vital to businesses. And the cash flow statement tracks what happens with your cash coming in and going out over the period of time. It's very, very much in the same nature as a profit and loss account, only the cash flow statement looks at cash in and cash out over the period that you're looking at. And you might be thinking, hang on a sec, that sounds just like my bank statement. And yeah, it is. A cash flow statement is the same as your bank statement. The only difference is that in your bank statement, you say all the transactions in date order. So what came in and went out on the first of the month, the second of the month, the third of the month, and so on. And a cash flow statement that a business produces is just slightly different in that it's not showing things in date order, it's showing things in category order. So it'll show all the income that was generated during the period you're looking at, and then it'll categorize all the cash outflows into different cost categories over that same period. But essentially, it's doing the same job as your bank statement, the cash flow statement, the third of our financial statements. And you know what? Before we finish this one, I've got to mention that's a question. You're probably thinking it right now. But a lot of people ask, they go, well, if the profit and loss account is a video of things coming in and going out over the period, and the cash flow statement is a video of things coming in and going out over the period, what's the difference? Why do we need two statements? Aren't they doing the same thing? Well, no, they're not. And you know what? That's what video 2 is all about on accruals. It shows an example. And it's a very simple example of a small business just starting off, and it shows you what goes in the cash flow statement and what goes in the P&L and why they're different. So we'll get to that in video 2. But before we finish this video, at the end of each of our videos, there's a couple of questions for you to have a go at. So let's look at those now. So the first question asks you about the P&L account and what it shows. What does a profit and loss account or P&L account show? And the answer, you might want to pause the video and stop now before I give you the answer. Well, I'm going to give you it anyway if you haven't already paused it. The profit and loss account shows income and expenses, or income and expenditure. Yeah, the balance sheet shows assets and liabilities, and the cash flow statement shows cash flows. But the correct answer is number 2 to the first question. And the second question is, what statement is also known as the income statement. What statement also has another name that's income statement? And the answer is the profit and loss account. So that's answer number one. If you remember, the balance sheet has another name. It's the statement of financial position. The cash flow statement is just referred to as the cash flow statement. But the correct answer to question number two is number one. I hope you got those right. If not, go back over the video, make sure you understand things properly before you move on to video number two on the accruals principle. I'm Steve from Clearly Training. Thank you for listening, and I'll see you on the next video. Bye-bye.